Hi, I'm Roger Montgomery and welcome to this week's Video Insight. Well, several billionaires, some of whom have successfully speculated on gold, believe gold's advance isn't over. Now, notice I said they've successfully speculated rather than invested. I won't say invested because gold provides no industrial service and it doesn't generate any income. It's not much more than a bet on the fear of others increasing. And by the way, that includes the fear of monetary debasement, which can be fueled by monetary inflation. There are obviously many triggers for a rise in fear, and gold is the means through which those bets can be expressed. Generally, the high-profile investors that believe gold will continue to rise do so because of persistent economic and geopolitical uncertainties. Collectively, they see gold's rise as being fueled by a mix of inflation fears, a weakening US dollar, geopolitical risks, for example the US-China trade disputes, and strong demand from central banks and retail investors. Forecasts like JP Morgan's $2,950 an ounce US by quarter 4 2025 has already been usurped by gold's recent ascent. Ray Dalio, the now semi-retired founder of one of the world's largest hedge funds, argues that with central banks globally maintaining loose monetary policies and inflation pressures persisting into 25, gold retains purchasing power when fiat currencies falter. Emphasising gold's role as a buffer against the erosion of fiat money's value, he's quoted as saying, "If you don't own gold, you know neither history nor economics." Now, by the way, remember, Ray Dalio's probably forecast 15 of the last 2 crises. John Paulson Co, is another hedge fund known for his 2008 financial crisis windfall, who's also a gold bull. He sees gold as a critical asset amid economic uncertainty, such as lingering geopolitical tensions, including conflicts in Europe and the Middle East, and potential US recession risks this year. And I guess those recession risks have increased. His significant holdings in physical gold and gold ETFs reflect his belief that it thrives when markets wobble, offering a safe haven as global growth remains uneven and unpredictable. Peter Thiel, the Palantir co-founder, is a contrarian venture capitalist who views gold as a shield against weakening fiat currencies, particularly the US dollar. In 2021, Palantir bought $50 million worth of gold bars to hedge against, quote, black swan events. And Thiel's argument is that gold's value endures when trust in paper money erodes. Finally, James Rickards. He's a currency expert, author and financial commentator, and is often cited as one of the most influential gold forecasters. While he's not an investor managing billions of dollars like the others, nor is he a billionaire, Rickards has gained a strong reputation for his prescient calls on gold price movements. Indeed, his books such as The New Case for Gold, published in 2016, predicted gold's rise as a safe haven asset amid global economic instability, currency devaluation, and central bank policies that align with gold's ascent recently. In a post on X, back in late March, Rickards suggested that a higher gold price could benefit the US Treasury if it were to revalue its gold reserves on the Federal Reserve's books to generate cash without issuing debt. He stated, and I quote, "If the US Treasury plans to revalue US gold on the Fed's books to pull 800 billion of cash out of thin air with no debt issuance, it might be convenient to have the price of gold go much higher to increase their cash haul," end quote. In an interview on the Commodity Culture YouTube channel, Rickards reiterated his long-term view that gold could hit $23,000 per ounce. Now, I think that's attention-grabbing, but probably not right. He's consistently urged investors to buy gold, arguing that its price will climb due to increasing demand from central banks, declining trust in fiat currencies, and heightened geopolitical risks, such as the US-China trade tensions under the Trump administration. So whether it's persistent inflation risks, geopolitical tensions, currency concerns, or equity and bond market volatility, these investors' rationales, if not timeless, align with today's economic, financial and geopolitical landscape. And obviously, as the gold price rising reflects, currently these views are in the limelight and being supported. Now, in our next series of this two-part series, I'll present the bear case or not the bull case, so stay tuned. In the meantime, continue to follow us on Facebook and X.